So having a look at a chart of the US 10-year bond, we can see that the yield has reached around 3.15%, which has been a significant level over the last number of years, and which signals where buyers have come in order to support the US bond market. Technically, I do see a double top forming and a break of the upward trend line going back to the mid 2016s could signal a short-term bull run in US Treasuries. A break of that line would be confirmation of that particular setup. Having a look at another chart, I'm having a look at the MSCI All Country World Index versus the S&P VIX futures. What we have seen is the All Country World Index losing its 200-day moving average and starting to move to the downside, while the VIX has started to tick higher. On the VIX, there is definitely an opportunity to play the volatility um, with minimal outlay, I should say, by basically buying call options on on the VIX futures. But if you want to know more about call options, please chat to the trading desk about that because that's actually quite an exciting space to play in. So we've seen volatility rise over the last number of days, and that's been a great place to be if you were long some call options on the VIX and perhaps short on the S&P. Having a look at the chart of the S&P 500, the PE ratio, so this is the price earnings ratio, and basically this gives us an understanding of what valuations look like from an historical perspective. So as you can see in the on the right hand side, we've got it's circled. So we're basically sitting at the upper end. We're sitting at a PE ratio of above 20, which historically we've only done between let's call it around 14.5 to 15% average for the price earnings ratio on the S&P. At current levels, we are looking quite stretched. So that could possibly be a reason for some of the derating that we've seen. So some of the higher growth stocks where growth is not materializing and where problems are starting to creep in. Those are the same stocks that have kept the market going over the last number of years. So we are seeing a bit of a derating, and hopefully that PE ratio starts to come down for more attractive buying levels. But I would definitely look to get in at lower levels to pick up a couple of bargains, especially in the offshore space, because in the offshore space we've got a multitude of stocks as opposed to the South African market where we only have a handful of securities to choose from. So I would say that definitely have a look in the offshore space to see where there are any opportunities. If we have a look at the chart of the S&P 500 going back to March 2009, we can see that we're still in a major bull channel. So only a break of this channel would signal a potential into the long-term bull market. So from March 2009, we've traded in a major upward bull channel, which has been supported by lower interest rates, as previously mentioned. One thing that's also been supporting the bull market is also the companies themselves. I've got a chart of the S&P 500, the total shares outstanding. So as you can see, since money has become cheaply available, we've seen um, companies repurchasing their own stock, reducing the number of shares outstanding with cheap financing, and being able to support the bull market by continuously buying these equities. So as US rates are starting to rise again, it becomes a bit more difficult for these companies to actually keep supporting their own stock and elevating the stock market. So interest rates starting to rise. However, companies, especially companies that are highly geared, are now unable to maintain that same rate and level of purchase as we have seen since 2010, 2011. We've also, yes, as I've mentioned, we've seen the buybacks as caused by the low interest rates. Having a look at the chart of the top 40, taking it back to around 2001, 2002, we see a big rising wedge forming. And on the top 40, the 43,000 level is a key level on our index. We've seen the rising wedge, we've seen a bit of a pullback, and now we see this market actually starting to look like it's starting to roll over the longer term. As you may already know, our market is driven by a handful of shares. For example, we've seen Naspers, Tencent, in recent years, British American Tobacco, we've seen Richemont all hold the market up, basically being supported by a weaker rand that has supported earnings if translated back into rand. So as the rand starts to strengthen, those companies they weigh on the index. As the rand weakens, it supports the index. However, 43,000, a key level on the index that needs to be monitored. If we do see a breakdown that below this level, it could possibly be signal a further downside. However, I would say that there are selected opportunities, possibly in local equities. However, that also largely depends on the growth outlook for the South African economy, especially the SA Inc stock. Another thought is the ICA's MSCI South Africa. So this basically gives us a view of the South African market in dollar terms. So we're having a look at the market. We're seeing the market approaching the trend line going back to late 2008. I'm actually wondering if there could not be an opportunity to purchase and pick up some South African, some SA Inc stocks around current levels. So if we have a look at the trend line, I've just circled, we may find some support around that level. So definitely chat to the trading desk and find out where there are opportunities in the South African market, possibly in some SA Inc stocks, some bargains over there where there could be some major upside on very attractive valuations. Having a look at some of the base metals, we've seen this being driven by Chinese industrialization, economic expansion. We've seen the peak in 2008 before the crisis. We've seen a 5-year sideways range. We've seen oil going lower from July 2014 up till January 2018 on concerns over China's hard landing as well as supply. But since then we've seen a recovery and currently trading in a sideways range. We see copper having broken out of a multi-year downward trend, pulling back. And I would say that this is possibly an opportunity to look at copper and some of the miners again. If we see another pullback in the miners, that could actually be another opportunity. So I would possibly say there is possibly another leg up to those miners again, but we need to watch for the pullback in order to determine where the appropriate levels are to get in. So that's one of the areas. If we have a look at another base metal, we're having a look at nickel. We've seen the long-term breakout. Now we're seeing a bit of a pullback again. So the retests are so common. We're basically seeing a pullback, and this could mean another opportunity to purchase again. On the base metals, a multi-year breakout, a medium-term pullback. However, looking at the short-term weakness as another buying opportunity.